when you're young, you can take a bit more risk, especially in asset classes like the stock market. You can give it more time. Start small so that you can learn the process. The very straightforward ones like the fixed income instruments you get in the market, the fixed deposits, commercial paper, debentures. So some of these things you might need a minimum amount. It becomes a substantial amount. You can then shift it to another instrument or an asset class. Because you may set your financial goals, but you don't have to save all of it. The objective here is to gain financial freedom, which is when your money works for you and you don't work for your money anymore. So in order to achieve that, you need to start as young as possible, because the more time you give your investments, the more it will grow. And also when you're young, you can take a bit more risk, especially in asset classes like the stock market. You can give it more time. Start small so that you can learn the process. The most important thing is to get into that habit or the discipline of putting some percentage of your earnings aside as savings, even if it's a small percentage, with your lifestyle expenses. Get used to that discipline and make it a habit to do so. And with the effects of compounding, if you allocate your investments into different asset classes, you should be able to achieve your financial objectives over a period of time if you maintain the discipline. When considering instruments to invest in, you have to look at the risk, liquidity, and return of that particular instrument. To start things off, you have to first understand how each and every instrument works. So if you take the available instruments in Sri Lanka, in this country, you can probably look at the very straightforward ones like the fixed income instruments you get in the market, the fixed deposits, commercial paper, debentures. So some of these things you might need a minimum amount. A good start would be a unit trust, maybe a money market fund, or any fixed income unit trust managed by professional fund managers. That would be a good start where you can build up your savings, and once it becomes a substantial amount, you can then shift it to another instrument or an asset class. If you are going into the stock market, then you have to understand before you buy a stock how that company operates, the dynamics, the macroeconomic factors that will affect the operation and the profitability of that company. You should not buy a stock just because you have been told to buy that stock. You have to understand the growth potential of that particular stock. So between unit trust, fixed income, and the stock market, you can, depending on your financial objectives, you can have a mix. But I would say at the very beginning, stick to a unit trust, build up some cash, then shift into deposits or commercial paper, fixed income instruments, and then once you have some sort of holding power, you can go into the stock market with good counters that has potential to grow. Yes, understanding the effect of compounding is definitely going to motivate you to save more. It's a very interesting concept because you may set your financial goals, but you don't have to save all of it. You can let interest around interest and your money grow. You have to let it compound. And how you can get a rough idea of how long it will take, for example, for your money to double, would be to use something like the rule of 72, where you take the interest rate, you divide 72 by the interest rate. For example, if the interest rate is going to be 18%, it will take roughly 4 years to double your wealth if you get an average rate of return of 18%. So that's just to give an idea or an example of how the effect of compounding can make your money grow. So it's very important when you earn interest to reinvest your capital along with the interest. to get to your target portfolio size in a reasonable amount of time. If not, you have to save your entire portfolio, so you have to let your interest also earn more interest year on year. In that way, after a period of time, you will have a substantial amount of money for your financial freedom. To be honest, there's no such thing called the best investment. It all depends on your financial objectives. You have to always be in a mix of asset classes, because each and every asset class will have different features. So usually when you're making an investment decision, when you are structuring a portfolio, you should look at the most common three factors, which would be the risk, liquidity, and return. So each and every asset class will have different levels of liquidity, different levels of risk, and different levels of return. Having said that, you can structure the portfolio in a country like Sri Lanka in government securities, bank deposits, fixed deposits of finance companies, corporate debt paper like commercial paper, debentures, and securitized paper. You can go into the stock market, you can go into professionally managed unit trust funds, and you can go into real estate investments. These are the commonly known investment asset classes or investment options in Sri Lanka at the moment. When you're also structuring your portfolio, you need to understand your cash flow requirements, your liquidity requirements, and work with the tenors and the instruments accordingly. Having said that, you have to always look at the market conditions as well. In a time period where the interest rates are low, you should not go long term. When the interest rates are fairly high, north of 15%, you can consider going medium or even long term. Beating inflation, in other words, avoiding capital erosion, should be one of your key targets. Apart from that, diversifying the risk, getting an optimized return, and then maintaining liquidity to cater to your financial objectives are the important things to consider when structuring your portfolio.